Hello, and welcome to another edition of the NRS Retail Insights Podcast. I'm John Lofstock, and today I'm happy to be joined by Mark Radosevich, the President and CEO of PetroActive Services. Mark has, I love to say this, nearly 50 years of experience. Do I have that right, Mark? Almost 50 years?
You're aging me too much. 45.
45. Okay. Years experience in this industry as both a retailer. You did the work for some big oil companies, and as a consultant and finance guru and an author. He's been writing a column out and about in the industry that appeared in my old magazine, C-Store Decisions, for about 20 years, and other industry publications. So welcome, Mark. How are you?
I'm doing great. Thank you. Appreciate the opportunity to speak with you.
Good, good. One of the reasons why I wanted to talk to you with the Casey's deal obviously just went down, but since COVID, what's the state of money right now in finance for small and mid-sized operators? Is there, how are banks helping out retailers these days?
The air is getting pretty thin with available cash. Buyers have to have a pretty decent sized war chest of equity to put in a deal. Banks are really looking tight and turning over every rock in the deal. It's not as easy to access capital as it was, several years ago. I think, the days of the 90%, loan to value deals are pretty much behind us. I'd say marketers that are going to acquire sites really need to be looking at about 20-25% available cash. Anything less than that, I think they would have a hard time financing it.
So companies like Casey's that could pull off these big deals, I would imagine it's a lot of cash on hand when you start talking about companies of that size.
Right. Yeah. I mean, publicly traded companies are in a different world than your multi-generational marketer that may be significant in their geographic area financially and with their retail presence, but the ability to access significant amounts of capital for a larger acquisition are constrained at best right now, I'd say.
Okay. And now, what about, it's still borrowing, but what about access to capital for just upgrades? Maybe it's not the $30 million, but is there some money available to upgrade your stores, to put a facelift on, to build a food service counter? Kind of the things that small and these mid-sized retailers need to grow.
Yeah, I think that deals more with a relationship bank, someone that sees a business plan that includes enhancements of the operation, and that would trickle down to enhancements of their bottom line. And I think there could be money accessible for that through existing relationships. I think if you were going to go out and try to garner a war chest of money to do significant upgrades with a new lender, I think that might be more challenging. I would say, and this goes back to the days I was financing larger transactions with a Lehman affiliate before we really got aggressively into mergers and acquisitions, was that the availability of cash is really predicated on the quality of the borrower. I just think that a marketer needs to really plan in and have an assigned person to be garnering capital. It's not something that you do on a one-off basis, but it's a process constantly trying to enlist interested borrower lenders to be able to meet the needs in the future. I would say, we used to say, if you're going to make an acquisition, get pre-approved to a certain amount so that when you pull the trigger on the deal, you're not holding up the deal because you're waiting for the bank to approve it. If you get pre-approved, then it makes the deal easier, and the seller is much more prone to accept a buyer that has a financing contingency. Same thing with upgrades and improvements. You need to really be constantly looking at the need, the amount of the need, and how that reflects your bottom line, and then assessing opportunities with lenders to be able to meet that need. And that goes back to what I used to always say: the holistic approach to running a C-store chain or any business is dealing in processes, not programs, where you're in a continuous improvement process, where you're setting a plan, you measure the plan annually, and then you fine tune and adjust the plan tactics annually for the next year. So you're not constantly stopping and starting. You're developing a continuous improvement process, and that includes lending. That might include site selection for new to market sites, where you are out there constantly enlisting commercial realtors to find you a specific type of site that you want to buy and build, and not to say, well, this year we're gonna look for a site. No, you're constantly assessing opportunities, and then with a pre-established lender approval, you can then pull the trigger on those and begin a site, improving your chain by adding good sites and divesting the marginal stuff, continuously improving the chain as well as the bottom line profitability. And I guess the last word on that would be, being the biggest isn't necessarily the best. I like to say you want to optimize your operation, not maximize, because it comes down to what your net earnings are, and that translates into your business value. Kind of got a little long-winded there for you.
No. I was listening intently. One of the things that we talked about through the years, and I haven't heard this term in a while. I haven't, been doing a lot of finance articles lately, but sale leasebacks and things like that. So I'm just wondering how people can get creative with money. Let's say I have 10 stores. There's a competitor in town, 8 stores, and I have an opportunity to buy them. Now all of a sudden I need money. What are some of the creative ways that people can find money nowadays? Is, other than, doing all the little things right and going to the local banker, but let's get creative and put on your M&A.
All right. Well, when you talk about sale leaseback, that goes back to my days working with Petroleum Realty, which was a Lehman Brothers affiliate in the early, 2001 to 2003. We were aggressively looking for properties as a REIT type company, where we would buy the real estate and lease it back to the operator, and that was a good example when you mentioned sale leaseback. We would always strive for a blend of sale leaseback before we would bring debt into the equation. The reason is our motivation was really to create a portfolio of properties with good operators that would be our tenants. Now, back then, the interest rate environment was probably higher than it is today, although the interest rate environment today is not the way it was a few years ago, when the sellers could potentially lease their sites to a credit tenant like a 7-Eleven or Circle K, and then on a secondary sale, sell that lease to the 1031 market, doctors, lawyers, investors, and garner a secondary amount of money because the cap rates were so low. And when you have a low cap rate, that translates into a much higher ticket price. So I guess the answer now is yes, sale leaseback is a vehicle. It can help overcome shortfalls in equity. The only thing I would say is the cap rates have gone up from, the credit tenant 4.5 to 5.5. I think solid marketers are looking at probably, 7, 8s, 9s on the cap rates. Dealer caps are probably closer to 10 or 11. But really, there are investors, because you want to track what can you make on a CD, 1 year, 2 years, 5-year CD versus what's your margin on owning the real estate, because there is risk having a C store as an investment, in the event that, let's just say it's an average site or good site, but a big competitor comes in, and, a sophisticated Wawa type competitor comes in, and all of a sudden your tenant, is his business enterprise is constricted, and he's not able to make the rent. The risk is you don't want to take back a site. So there's a balance between the expected income with that risk built in. And I would say that, yes, if someone found a portfolio of stores, there would be an appetite from the Getty Realties or other REITs to want to invest. Now, on the other side of the coin, being on both sides of the financing equation, because when Lehman pulled out, we did a lot of debt origination with life insurance companies and with companies like GE Capital. Mm-hmm. The key is a marketer's goal is generally to own the real estate, because that's where the long-term value is for that family and that business. Enterprise value is one thing, but owning the dirt is really kind of the end game. So an all-in strategy on sale leaseback may be possible, but the balance is trying to balance the blend between sale leaseback and debt, so that at the end of the day, you end up with some properties that accrue to the bottom line of the company. Mm-hmm. The other last comment on sale leaseback that is worth noting is a lot of leases are harder to, once they're established, they're harder to assign, because the landlord, the investor, has covenants in that lease that require a credit value of the assignee to be equal or better. So you could find, well, in other words, you're not gonna do a deal where you're the chain operator and all of a sudden you're going to assign that lease to, say, a single site operator, a dealer. It's going to be very difficult. So those types of the parts and parcels of the lease need to be scrutinized closely to make sure that when you enter into a sale leaseback, you're not tying your hands too much on your future the future disposition of that property in the event you want to exit out before the lease expires.
Yeah, and I don't know if these were sale leasebacks, but was it Luke Oil up in my market where they had these dealers in there and they had volume requirements on them, and all this competition moved in and they couldn't meet their volume requirements, so the volume requirements went up every month, and they started just walking away from they didn't own the dirt, so they just walked away.
Well, yeah, I wish I could say that we didn't have an experience with that, but we did have a little experience with the Getty marketing and Getty Realty and the Luke Oil aspect of that in New Jersey, where we were trying to help Getty marketing get out of some of these leases. And
hey, puppy,
it was challenging because the facilities were so poor because no one had put any money in them and improved them. Mm-hmm. And the dealers were just choking, and it was a mess. Obviously when you enter into a sale leaseback, you have to maintain the property and make sure, because there's covenants of maintenance in there that you need to make sure that dispensers work, canopies are not leaking, and everything is pristine.
Yeah. So, I'm not sure when the last time you were up in this market was, but you'd be impressed with how it's evolved with Wawa, Quick Check, Bola, Chestnut. There are big brands, big food service brands. Remember, New Jersey is still a state where you pump they pump your gas for you, so you don't have to even get out of your car. So it's hard to get food service. You got to be really good at Quick Check or Wawa to get people to get out of their car and go inside.
Yeah, I know the full service side of it, and the dealers had a union, if I'm not mistaken. It's a different market. I think Oregon might still be full serve.
Yeah, even they changed some of that. It's not all of Oregon either. I think it's just a few isolated places. Real quick though, I wanted to transition to, because you're not just a finance guy with all of your experience, you've seen all aspects of the industry. You guys do consulting for convenience stores, best practices, labor. Why don't you tell us a little bit about that side of the business?
Well, we do from the strategic side, the M&A, business valuations, assessment of the performance, the financial performance, and a lot of that when we do a business valuation or an assessment, it highlights needs in the operation, whether it's affinity programs, the merging the forecourt to the store. And we decided to enlist capable, highly talented advisors to join our team as a affiliated company to offer operation services from as simple as a single site to as complicated as a multi-site operation. And and that's worked out real well for us. It helps round out what our offerings are to the industry, and it's able to go beyond my personal capabilities. I was involved in retail when back in the 80s when my first stint was with Exxon, Esso, and internationally when we converted all the base sites to C-stores, and it took a definite petroleum angle versus the 7-Eleven inside of the store. It was really all focused on how do we do a C-store enough to keep selling gas? But now
that's kind of my history with you, by the way. I don't know if you remember this. My father was an Exxon Esso dealer in New York. And I remember you telling me about that. I don't think that was your market at the time, but they were trying to get him to convert. He had a handful of stores, but he was a mechanic. And the thought of selling drinks and snacks was the most unappealing thing in the world to him. So he just sold the company.
When I worked with an affiliate, SOCCA, Esso Caribbean Central America and Chile. We actually took C-stores into Chile. So my life for the first 11 years of the business was 1 week I'd be in Bermuda dealing with retail, and the next I'd be in Haiti. So all through Central America, from El Salvador, Guatemala, Panama, you name it, the Caribbean, Puerto Rico, et cetera, et cetera. And I never forget a dealer meeting we went to in Jamaica when I think we had like 50 or 60 stores in Jamaica, and there was a woman in the back that was a dealer, and it was a bay site, and she basically in her Jamaican accent says, "I am not going to sell rice in my store," and she was focusing on rice, and we were like. And I'm looking over at the team saying, "Are we really going to sell rice?" Because I was thinking it was going to be more like hot dogs and sodas, but I don't know. It was a big challenge to convert, and then we also did a little stint with Texaco, same thing, except Texaco had a different way of doing things with modular sites, whereas Esso would build Stonehenge sites that were poured concrete that would last for the rest of the world. Where Texaco could put up a site in about 90 days, and it was just a different world. But nowadays, with the technology in C-stores and marketers needing to be really good at food service, and as well as being able to lock that customer into to loyalty programs, they need help, and we have found resources to help them do that. And our thoughts are, if we can make somebody's company better and more profitable, then when they are ready to exit, they'll think of us maybe to help them do that.
And I mean, that's the difference between hundreds of thousands, millions of dollars getting those little things right.
Totally. Yes.
All right. So we only have a couple of minutes left. I'm going to put you on the spot, kind of gun to your head right now. You're going to a convenience store. What are you buying?
When I go to a convenience store, Well, first thing, and I hate to say this, I use the restroom because I'm an older guy, and I typically look for, I look for for a restroom that because when I gotta go, I gotta go.
But no, again, that's a great observation, right? Not everyone has clean restrooms. There you go, right? If you needed a better reason,
Clean,
all right, what
clean,
else?
clean and convenient. I mean, to be able to go in there and not ask for a key or look in the back and have like the old style, you know. And the other thing I do is I typically will go in because I'm on the road. Sorry, my dog is just walked up here to the. She's a German Shepherd that gets a little excitable when she's not getting her exercise.
I understand.
I typically go to the soda fountain, buy sodas, Diet Coke. I like when I'm driving. It gives me a shot of caffeine and you know the peanuts and just snacks. I'm not, you know, I don't do really a deep dive too much into the pizzas and all, but I do appreciate when you know, sometimes I go in with the touch screens. We've got a very good operator here in East Tennessee. Weigel's, they have the touch screen ordering, and that's very convenient. But yeah, generally bathrooms, sodas, and peanuts.
I love for those who don't know, Mark is in just a beautiful part of Tennessee, and I think one of the prettiest regions of the country, but also very good operators. I mean, with the Weigels, even Pilot is just doing such a great job.
This market has a unusually high level of multi-store operators still. You know, the 25 to 50 store chains. I was a speaker at a conference last week in Gatlinburg, and the attendance was amazing. And we had easily 10 or 12 chain store operators that are local. And when I was in Florida, we saw those type of marketers disappearing. And basically Florida does not have a lot of store operators anymore.
No, they've become, yeah, it's become such a chain driven market down there. So now we're running out of time. I don't know if you can see the counter up there. So Mark, I'd be remiss. Can you tell people how they can get in touch with you and how they could reach out to you to get some insight and your expertise?
Yeah, my email is Mark with a K at PetroActive, PetroActive.net. Our website is petroactive.net. And my cell phone number is 423-210-0992. My office is open whenever that phone is on. So we invite inquiries about our business. And I'm an older guy, been a lot of years in the business, but I have a passion for the oil business, the C-store business. I love it. And I'm continuing to get up and go to the office every day and do my best to put bread on the table. So
yeah, I'm becoming an old guy too, and I tell you, I always prided myself on knowing the industry, but I take a backseat when it comes to Mark's experience and your knowledge. So Mark, I want to thank you very much. It was fun to catch up.
It was great seeing you again, John.
Okay, and thank everyone. Thank you all for listening. I hope you enjoyed this broadcast, and we look forward to having you on an upcoming podcast. Have a good afternoon, everyone.